Welcome to the Real Estate Rebel podcast. I'm your host, Scott McGillivray, and don't forget to like, subscribe, and follow us wherever you get your podcasts, and visit scottmcgillivray.com for all your real estate information. Now, today's topic is a must know, must understand for anyone looking to buy a house or to be a real estate investor. We are talking about financing, folks. Biggest question in real estate is, where do I get the money? Now, the answer is not as straightforward as everyone would like, because typically we get the money from a few different places. And there's conventional and non-conventional or unconventional financing. Today, we're going to talk about the conventional version of financing. That is typically in the form of a mortgage. This is usually where at least 80% of your financing comes from. It can be affordable. It can be accessible. It's leverageable. It's the thing that allows the average individual to control a tremendous amount of wealth. And I have said many times before that I just don't feel like we have been prepared as young learners for the home buying process. Largest financial decision we will ever make in our lives for most people. And typically when you go to get your first home is when you learn about the financing part. So I am going to give you some of the inside track. We are going to unearth some of the secrets about conventional financing. And we're going to make sure that we change and shatter your train of thought when it comes to getting into debt, because debt is typically associated with consumerism, which is not the type of debt you should be going into, ideally. But when you are financing real estate, whether it's your home or whether it's multiple properties, this is a totally different type of debt structure, one that we should be comfortable. It's the one that is the foundation for our entire economy. The stock market is a debt, is just debt for businesses. Every business borrows. And if you want to get into real estate investing, you need to understand how to borrow. So today we're going to talk about financing. And as you can tell, it's something that I'm passionate about. It's something that has allowed me to get to where I am in my career. I feel very fortunate that there's been a way for me to grow from having very little to being able to feel very comfortable as where I am in my life. And a lot of people know that I started off with one income property that I lived in with my roommates. I bought that house and rented it out. But I'm going to share with you at the end of this podcast where and how I came up with the down payment when I had no money. I had no money. Nobody was giving me money. I didn't borrow money from friends and family. But at the end, I'm going to tell you how I came up with the down payment for my first property, and then how I used 95% conventional financing to secure the rest. And before I do get to that story, we have a guest today. Well, his name is Kevin Reid. He is a sales manager for CIBC, and he has a tremendous amount of experience with mortgages. So I am going to mine him for all of his information so that by the end of this podcast, we can answer the big question of, where do I get the money? Beyond that question, we also need to know, what is the simplest way to access that capital at the cheapest form of financing? And I'm also going to ask him a third question, which will be, what are some of the non-traditional ways to get conventional financing? What are some of the other financing opportunities that are out there that we may not know about? Lots to cover today, so let's get right to it, and let's welcome our guest, Kevin Reid. Welcome to the podcast. You are a sales manager, but you have a tremendous amount of experience in the mortgage space. And today we're talking about money. Where do I get the money for the real estate? Thanks for coming on the show, and looking forward to getting some information out of you.
Thanks very much, Scott. Happy to be here. It's exciting to talk a little bit about mortgages, and hopefully our folks that are listening in today get something out of it.
Absolutely. So tell me what you do now and sort of your background on the financing side of things.
So at the present time, I manage a team of mortgage advisors at CIBC. I've done that for about the last 2 years. So they're an amazing group. I'm super happy and excited to work with them each and every day. They're a great group of people that do the job that I did for about 15 years prior. So I was a mortgage advisor, a mortgage specialist prior to being the area manager. So work closely with clients and, whether it be a pre-approval to purchase a home or refinance or switching in their mortgage, rental property purchase, construction mortgages, you name it. We work very closely with clients to take them every step of the way through that process.
All the good stuff. I love it. Well, I've always said that unfortunately, I feel like the financial literacy of the general public is not where it needs to be. Like we don't have a lot in the curriculum in our school system that prepares people for the home buying process, that teaches them about financing. So typically, when people go out to buy their first home or their first investment property, not only are they trying to learn the whole process about the properties themselves, but the whole financing side of things might be new to them. So my goal today is to make sure that people feel a little more prepared, that maybe by the end of our conversation, they might feel like they have a slight competitive advantage before they go out looking at real estate. They might be a little more prepared because it's all fun and dandy. It's all fine and dandy, and it's a lot of fun looking at properties. But when you have to start making payments, it gets pretty real pretty fast. So, talking about the money, I mean, the big question today is all about the money, and conventional financing is probably the largest portion of any real estate purchase. So, let's start with really getting into sort of where do I get the money? What's available? Like let's start with the sort of the simple question, but the big one is how does financing work? How does a mortgage work?
So yeah, essentially a mortgage is a loan, and it's a loan that's secured by a piece of property, a home. So where do you all start? Where do we start? We approach a lender, and as a mortgage advisor, that's our role, is to meet with clients and talk about the mortgage process and how do you go about getting a mortgage. So essentially, it's an application that we're going to put forward to the lender, where we look at things like your income to support the application, to support the mortgage, the loan that you're ultimately going to get. And we look at the property that you're looking to purchase that we're going to be securing it against. So the application does go in depth as far as your current address, your employment, what your income looks like, your credit history. That's a very important part of the application process. So it's very important that clients applying for a mortgage have a good credit history where they've demonstrated the ability to pay back some of the obligations that they've taken.
What about when it comes to a mortgage? I think people understand that it is specific for properties, and even more so for primary residences. But there's not a lot that teaches people about mortgages, and they're not all the same. What's the advantage to using a mortgage to finance a property?
Essentially, a mortgage is the traditional way to borrow when you're looking to purchase a home. A conventional mortgage is when you have 20% down, and we're financing up to 80% of the purchase. You can, if you're putting 20% down, you can spread the amortization or the mortgage life over a period of 30 years. And inside of that 30 years, you're going to have terms where the client can choose whichever term they prefer. Most often it's a 5-year fixed, but there are other terms, shorter terms, 1, 2, 3, 4, even 7 and 10 for customers that feel more comfortable locking in for a longer period of time. Rates are at historical lows at the moment, so we do look at what our client's comfort level is with locking in for what period of time, and then variable is another option where that rate could fluctuate or will fluctuate over the term. So you have to be comfortable if you're looking at that variable rate, just because it can change. Whereas a fixed, for example, a 5-year fixed, you know exactly what your payment is going to be for that 5-year term, and you know exactly where you're going to stand at the end of the 5-year. So, for example, if you take a 30-year mortgage, over the 5 years, you're locking in your rate and your payments, and at the end of the 5 years, you're going to renegotiate that interest rate, and at that point, you would have 25 years left in your mortgage, and then you continue on.
There's so many components to a mortgage. I think we sometimes over assume that people know everything about a mortgage when realistically a first time buyer has to do some research. They have to crunch the numbers. I mean, even a mortgage calculation, the formula used to calculate your payments is not a simple formula. I've tried to calculate mortgages manually before, and you need a mortgage calculator because it is complicated. And basically, a mortgage is a loan, and it's a prepackaged specifically for a property. And then within that loan, you've got different options on sort of the lengths, which is called the term, or that's the amortization. Amortization is the length of the entire thing, and that can be what, 20, 25, or 30 years?
That's right. 30 years would be the maximum mortgage life or amortization. If you have less than 20% down, then you would have to have a maximum amortization or mortgage life of 25 years.
And what's the benefit of stretching something out over 30 years?
Well, when you think about borrowing for a home purchase, oftentimes it's the biggest purchase that a lot of people are going to make. So it is a larger loan, and to have a shorter period of time would mean a pretty hefty payment to pay it off. So we do have the ability to extend that mortgage life over 25 or 30 years max, to ensure that the payment is manageable. When you think about purchasing a home, the mortgage payment isn't going to be the only a financial obligation that you're going to have. You're going to have some other expenses such as property tax, utilities. So we do want to make that payment as manageable as possible. And we use ratios to make sure that the client qualifies, and that when we do advance a mortgage and we lend the money to the client to buy their home, that the payment is manageable. So whatever income that they're bringing in is enough to support the amount of the mortgage and the payment that they're ultimately going to be making.
That makes sense. So amortization is basically the shorter the amortization, the sooner you pay it off, but the larger your payments are. The longer the amortization, the lower your payments become because it's stretched out over a longer period of time. Now, the term is within the amortization schedule, which basically just agrees to your rate for a certain period of time, correct?
That's correct. And it's worth pointing out too, most times with clients, we want to make sure that the payment is going to be manageable. So a lot of times folks will want to pay off that mortgage as quickly as possible, and they will want to go with an aggressive amortization, which is great. And we encourage that. But at the same time, you don't want to overextend yourself. There could be some unforeseen expenses that will come up, some improvements that they may want to make. They still also, have to live their life and do some of the fun things outside of paying for a mortgage. So what we normally recommend is make sure that you set an amortization or mortgage life that is manageable, and knowing that you can still make extra payment towards that mortgage to pay it down quicker. So, maybe you have a goal or a dream to pay it off in 15 years, but the payment is fairly aggressive. You can do it over 20 years, over 25 years, and do extra payments along the way. Also, when that term comes due, let's say you take a 5-year fix, when that term comes due in 5 years, you are able to put extra money down on that anniversary date to pay it down. So let's say you've saved up some money over the course of the 5 years, or a bigger bonus comes in, and you've saved that, or an inheritance, whatever it might be. You are able to put that money towards the mortgage without any type of prepayment penalty at the 5-year mark, in addition to extra payments along the way. So with every payment, you can add to your payment, which ultimately will be straight principal, and will bring down the mortgage balance and ultimately the mortgage life or amortization.
What are some of those, what are some of those kind of, not secrets, but what are some of those strategies to being able to pay down your mortgage faster without incurring a penalty?
Well, I mean, the additional payment is probably the most common. So if you've saved up a little bit of money in your account, in your savings account, and you want to apply it towards your mortgage, you can do that on each and every payment. You can add money to each and every payment to the amount of your total payment. And if you let's say you take advantage of that, in addition to that, you can also put 10%, traditionally 10% of the borrowed amount on top of that as well, to bring that principal down. So Going back, it's great to pay the mortgage off fast, but in the start, when you first applying for your mortgage, especially when you're a first time home buyer and this is all new, you
Yes.
really want to make sure that you set a payment that is going to be manageable, that you're comfortable with, knowing that you can take advantage of some of these extra prepayment options along the way to pay it down quicker. And then when the term does come due, it's fully open at that point to, either wipe out or chunk down a bunch of money before renewing into your next term.
And that's something that I like to use. Typically I'm going for. There's lots of different variables, but typically I'm looking for what's going to get me the best rate. And I know I'm not alone with that. Getting the best rate is super important to most people. It typically allows you to have the most flexibility in terms of what you do with your cash flow as well. So rate is important. And fixed and variable have different rates, and depending on whether you do, open or close. I mean, there's so many different things. Let's just talk about fixed and variable for a moment. Help people understand the difference between fixed and variable rate mortgages.
Definitely. And when we sit with our clients, it's important to know what their goals are and what their plans are and what they foresee in the future before we make a decision on locking in for a certain period of time. As well, historically, variable mortgages have saved people more money and paid off mortgages quicker, especially when we see rates coming down in the environment that we've seen over the last little while, and been through it a few times now where rates have gone up a little bit, but then they've come right back down. So variable is certainly attractive when you see rates coming down, especially as low as they are right now. However, they're not for everybody. My advice is usually, if you're going to be thinking about your rate every night and you're losing sleep over it, maybe variable isn't the best place to be. And I think the stat that I came across was about 70 to 75% of Canadian mortgage holders are usually going for a fixed term. It gives you the comfort level of knowing exactly where you're going to end up at the end of your term. Let's say it's a 5-year fix. You know exactly how much money you're going to be owing, as long as you made your payments along the way, of course. And if
Mm-hmm.
you've done some of the extra prepayment options, then you're even more ahead. But we really have to look at each individual situation and find out what's going on with our client. Does it make sense to lock in for 5 years? Why are they buying this property? Or do they plan to move in a few years? Well, maybe locking in for a longer term isn't the right way to go. Let's look at, like you said, interest rates, of course, are important. There's more than just interest rates, of course. But take a look at all the different rates and terms, and which one are you most comfortable with. Again, variable can fluctuate. So as soon as rates go up, all of a sudden more money is going towards interest and less towards principal. So essentially you've extended the life of that mortgage. And you have to be comfortable with those fluctuations that come with the variable, and they can go up and down pretty quickly. And a lot of times you don't want to be timing when is the right time to lock in. Usually you've missed it by that point, because things move so quickly in the economy with rates changing, that you really don't want to time it. A lot of times we recommend diversifying, like an investment portfolio. You have some riskier investments than others, and some that are more
Mm-hmm.
guaranteed. So if you do have multiple more, let's say you have an investment property and you have your primary residence, a lot of times we'll recommend diversifying, have one that's fixed and have one that's variable. If rates start to go up, you're certainly happy that you locked in on the fixed term and didn't go all variable. And in the flip side, if rates come down, well, you're happy that you have a variable that's coming down with it, and still have the security of that fixed rate mortgage, knowing exactly where you are.
Absolutely. I'll say personally, variable has been my best friend. I've done both. And typically, I find every fixed rate mortgage that I have gotten into, at some point, I am just like, I cannot wait for this term to end so I can get into a better rate.
Yeah, absolutely. It's important to have a good relationship with your mortgage advisor and your financial planner, for that matter. And like you, I mean, I've done the variable rate mortgage, and I love it. I've traditionally was a variable person. Now, with rates bottoming out a couple times now, fixed certainly is attractive as well. So I've gone the other way and gone fixed also. So there's certainly benefits and pros and cons to both, and you really have to make sure that you're comfortable with which one you ultimately choose, to make sure that down the road, you're in a good position and still meeting your financial plans.
Absolutely. One more component that people may not be aware of is an open versus a closed mortgage. That's another option. We got our amortizations, we've got our terms, we've got fixed versus variable, but then you have an open and a closed mortgage. What can you tell us about that?
That's a great question, and there's goes back to our point before. There's so many different things to learn about with mortgages, and that's why it's important to ask these types of questions when you're sitting with your mortgage advisor. And it's important for us to explain to our clients so that they can make an informed decision. So you're absolutely right. There are traditionally two different types of terms. One called closed, and the other called open. Essentially, think of open as open to prepayment. It's open to be paid off at any point that you wish. You're not restricted in any way, shape, or form with an open mortgage. You can pay that thing off at any point in time without any prepayment penalty along the way. Now, traditionally, an open mortgage would come with a higher rate because it has that open
Boom.
feature. And open
Yeah.
mortgages are traditionally only on a variable term. So we have a variable open mortgage, and that can be paid off at any time. Important to note as well that lines of credit are also variable rate. They will fluctuate, and secured lines of credit are an option outside of a mortgage, and those are also open also. So that's another option to borrowing. The line of credit, the benefit is that it revolves, similar to a credit card, but of course not with the credit card rate because it is a secured line against the house. But you can borrow against that line of credit, so you can pull money from it and you can pay money back towards it.
Yes.
It's completely revolving, whereas a mortgage is terming its way out. So as you make those payments, you can't necessarily borrow back off of that mortgage without refinancing it. Now, we do have a product, and the banks have a product that will allow you to go back and add on and blend. So that gets into some other things. But anyways, back to what we were talking about: closed versus open. All fixed terms are closed mortgages, as well as the variable closed. So they will come with more aggressive rates because they are closed, and it's closed to prepayment. You can't go in and pay off that mortgage entirely without a prepayment penalty. So you want to be cautious of that. But going back to your point, our point earlier about extra prepayment, you can have a closed mortgage, which is a locked in or a closed variable at an aggressive rate, at a good rate, at a lower rate than the open. And you can't, although you can't pay it off without a penalty, you can pay it down without penalty. So you can do those prepayments on actually, you can double up your payment. You can you can change your payment to an accelerated pace, which you touched on, which is just basically turning up each payment a little bit to pay it off a little quicker.
Yeah.
And you can do your lump sums on a closed term. So you do have those options to pay it off quicker. You just can't go pay it off without pay it off entirely without a penalty.
There's a lot going on with mortgages here. It's a lot for people to understand, and I think it's important to recap. There's a whole bunch of different types of mortgages that allow you to do different things. Some of them allow you to pull equity out to further down the road. Some of them are revolving, like you said. Some of them may actually advance construction funds and things like that. But the four things, there's really four parts to every mortgage that everyone should understand. That is the amortization. You have to be able to pick what that is. Your term, you need to be able to understand and pick what your term is. You have to know the difference between fixed and variable, and you need to know whether you're going open or closed. Once you have figured those out, then you can narrow it down to a small variety of products that might be mostly appropriate for you. And this is something they should teach in high school. There should be a course on this. And speaking of which, we're still just on the first point here, which is where do I get the money? And we now have answered that. Conventional money is in the form of mortgages, is pretty much the cheapest form of financing that you'll get. But I want to get into number two. This one is a question that a lot of people ask me. They say, what's the way I can get the best rate? How am I going to get the best rates? And how can I qualify for the most amount of money that I can afford? So what can I do to make sure I qualify for the most and I can still get the best rate? So these are the factors that you're going to basically be qualifying people on. So let's talk about that.
Yeah, absolutely. So when we talk about getting the highest mortgage, let's go on the second point first. There's a couple things that we look at. Keeping our unsecured debt as manageable as possible or eliminate it altogether will push our mortgage approval as high as possible. So when you think about the client coming in who has no debt whatsoever, we will be able to approve them for more than somebody who does have debt coming in. So that unsecured debt will take away. Now, having said that, debt that you will need to take on, of course, whether for an education or to purchase a vehicle or for whatever reason. So we do work with some ratios to qualify our clients to the most amount. So for example, 44% is typically the max. So 44% of your gross income, your before tax income, is what we look at as being a reasonable amount to pay in debt, whether that be the mortgage or unsecured debt as well. So we take your annual income or your monthly income, we take 44% of that, and we say this is the amount that is serviceable or is reasonable to pay from your total income, and that's how we get the mortgage amount as high as possible. It's important to come in and get that pre-approval so that you know where you stand. There's nothing worse than going out and falling in love with a home only to find out it may be above your budget, or what can I do to get to that point. So a lot of times, clients will come in and we'll look at the overall picture. We say, look, if you can work hard to eliminate this item here, you will qualify for this amount. And then, sure enough, a couple months later, we'll see that amount has been eliminated, and now they're in position. So, but that only comes with coming in and doing a pre-approval, so that you know exactly where you stand, so that when you're out there working with your real estate agent and looking for a home, you know that it's within your budget. We do look, of course, at credit history. So it's important to maintain a good payment track record, whatever car loans or credit cards that you may have obtained, that you're making those payments back in a timely manner. That way, when it comes to getting the mortgage, you've demonstrated a good prepayment, a repayment history, and you're showing the lender that you're good for the money.
So the things that you guys can dial up and down, the main categories are your income. Greater your income, the better it's going to be for your ratio. The lower your debt, the better it's going to be for your ratio. But then credit score, which is something kind of outside of that, is there a certain number, or is there thresholds? Like if your credit rating is 600, then this. If it's 700, then this. If it's 800, then that. Like, how does that work?
So we don't have certain thresholds that says if your credit score is X, you will qualify for this amount. It's more or less a yes or a no answer when it comes to your credit score. Is your credit score strong enough that we're willing to say that the bank or lender is willing to say yes to that mortgage? So credit scores will range, from 4 to 900. Anything 700 plus is really where you want to be. 600s is really middle of the road, and there may be something going on there. It's really important, and a lot of clients don't realize this, but and I didn't realize this early on. When I was younger, it's really important to make your payment, and B, this is the one that a lot of clients don't realize, is that if you miss a payment, it will impact your credit negatively, as will going over the limit on one of your credit facilities or approaching your limit. So, if you have a credit line or a credit card, let's say a $10,000 limit, as you approach that limit with your balance, you will see your credit score start to drop. So it's really important to stay well below your credit limit when possible, or at zero is even better. Use it as for convenience, but pay it off. You really don't want to be paying these high interest rate on credit cards. Not to mention, what it's going to take away your borrowing capacity when you go to apply for the mortgage. And if you are approaching your limit, it will also pull your score down. So essentially, when it comes to a score, we do want to see 700 plus credit scores is essentially strong. 800s is as strong as it gets. 700s is more typical. 600s is middle of the road. Anything below mid 650 below becomes a little bit of a challenge. We may have to do some work there to get that credit score up to where it needs to be. And going back to something we talked about not too long ago, we're not really told that when we were younger. Through high school, and it's easy to get some of these credit cards early on, and we really want to make sure that we're aware of the impact that those credit facilities will have later on when it comes time to buying a home or getting that car loan or whatever borrowing may be. You really want to make sure that you're using those credit facilities the right way and paying them off, and not paying any more interest than you have to.
That totally makes sense. And those are probably the three big things that you guys are looking at. But what are some of the alternative opportunities that people can bring to the table that might help them qualify?
Yeah, we certainly look at all aspects of an application, and no two applications are the same. Income is income, and there's different sources of income. You know, it could be investment income that a client is drawing off of investments, and that we can include in the application to help service the mortgage. Their employment income is the most typical income that we see. You know, clients working on salary or self-employed, whatever the case may be, and we can use that income in the application to help service. Rental income is still income. Pension income. You know, as clients get a little bit older and retire, of course, pension income is acceptable. So we will look at all the different revenue streams to help support the mortgage. Down payment is a big one as well. You know, the more the down payment, the less we call loan to value. So the less the loan is relative to the value of the property.
Yeah, lots of stuff there. I mean, geez Louise, I've tried just about everything to make sure I can get as much financing as possible or as much as I need for a property. I want to get to the third point, though, too, before we dig into too much of the semantics, because most people are really kind of looking for some guidance, and then they can come to you, they can come to CIBC, and they can go through all those finer details. But I do want to mention the sort of this third piece, which is some of the financing strategies that people are unaware of, and also the opportunity to possibly use even equity in one residence as a down payment to buy a secondary residence. So what are some of the financing tools? What are some of the things that still fall into the conventional financing space that might not be as obvious as going for, you know, a generic mortgage?
A lot of times we purchase a home and we aggressively pay down that mortgage, and at the same time we've been pretty fortunate in Canada's real appreciation in property value. So essentially that contributes right to our net worth, that equity in that property, the mortgage balance that you've paid down, plus the home, the investment that's appreciated, is equity that we have the right to. So we could sell that property and take that equity and put it towards another property, or we can reborrow against that property. So you can come back to your lender and say, look, I've built up equity in this property. I'm considering a rental property purchase, or I'm considering an investment property purchase, or any type of investment, or any borrowing need for that matter, a vehicle, child's education, whatever it might be. You can go back to the equity in that property. So you can't go back to the full value of that property, but you can go to 80% of the current value of your home, and that's called a refinance or an equity takeout. So you would have to requalify at that point, unless you have a product like our home power plan, which automatically gives you access. So if you come back and you refinance and you pull that equity out, you go back up to 80% or anything in between, you can then take that money and use it as a down payment on investment property or any other borrowing need that you may have. So equity in property is a great thing. Certainly gives you leverage. It certainly gives you an option to pull from that property to go do some other things. Bridge loan's a little bit different. A bridge loan, and I think there's a little bit of a misconception out there on exactly what a bridge loan is. And essentially a bridge loan is a loan that we utilize when you have a purchase and a sale happening, but the purchase is closing first and the sale is happening after. So as long as there's no more than 90 days between those two things, you can utilize a bridge loan. And a bridge loan is only applicable when you have a firm purchase happening and a firm sale. So the bank or lender will see that the sale is happening, but since the sale is happening after the purchase and the client requires the equity from that property from the sale for the purchase, we will be able to do a bridge loan where we advance, we do a pretty easy calculation to see what the proceeds are going to be coming from the sale, and we advance a loan on the purchase day to give you your down payment. Fast forward, the property finally sells afterwards, and the equity that comes out of that sale is then applied. Your solicitor will take care of that. Your real estate lawyer will take care of paying off the bridge loan, and then you'll get any other proceeds that may come out of it. So a bridge is there to essentially bridge the gap of close dates when your purchase is happening before your sale.
Okay, So that's pretty good. I mean, we got some interesting techniques. We've got all the basics covered. I mean, anyone who's looking to secure financing, they need to know these things before they go out and get a mortgage. But I do have a couple. I'm going to fire off three fast questions here for you that are just a little bit more insight into the lending space. With all of your experience in this space and conventional financing, can you tell me how the pandemic has impacted things, if at all, for you?
Yeah, that's a great question. COVID has really accelerated and pushed things along very quickly in the financing space. I've been through a few different things in the past. The subprime and back in 2008, 2009, and thinking, wow, we're never going to see this many changes this quickly. But sure enough, COVID has come along and really changed things very, very rapidly. Essentially, the biggest thing is it's really forced everybody to become comfortable with technology. Never in my life would I thought that we would have a fully remote option to complete a mortgage for a client. We've always had to physically meet with our clients to ensure that we know exactly who we're dealing with, of course, and take them step by step through multiple appointments. But at this point, we do have very secure checks in place to ensure we know who we're dealing with. But we do have the ability to complete a mortgage fully remotely with our clients, which is great. CIBC did introduce consent last year, which couldn't come at a better timing for with COVID coming up this year. So we are able to do something like we're doing right now, a virtual meeting with our clients. We are able to validate their identity, whether they're an existing client or a new client to the bank. And we are able to electronically gather all of their information. We can pull their credit bureau right on the spot with the client's authorization. Of course, we can collect their income documents virtually through secure email. And essentially, we can complete that application fully remote. And we're pretty proud at how quick we were able to come up with that option for clients. And essentially, it's COVID that really pushed the technology and forced us to become even more comfortable with technology and how quickly things are changing. COVID really has changed things, but we're adapting to the current environment really well. Really happy to also see that we will look at conventional mortgages. We will look at the client's income prior to COVID. As long as we have a good comfort level that income level will return, we are still able to lend based on income prior to COVID, which is
Wow.
great because we're looking at knowing that COVID hopefully is a shorter term thing, although it's painful at the moment as we go through it. We do know that there will be an end result and we will get by it. Hopefully, it's sooner than later, and life will return to normal for everybody for the most part. So using technology to complete our mortgages, mortgage applications, and still being able to look at what the true earnings will be from our clients once things to return to somewhat normal.
Hopefully things return to normal. But you know what? I think the silver lining is that maybe this remote approval process is a game changer for folks. So good news on that front. I work with a lot of investors, and one of the most painful things for investors is that they have the more properties they try to buy, the more problems they have with financing. And I do a tremendous amount of training, and I always say the more properties you have, the better or easier it should be to get financing if you're doing it properly. Now, part of that is about having the additional income and positive cash flow from each property, which can help qualify. But the other point as well has to do with being able to leverage more equity in the portfolio as you go along. But just basically a really quick answer for the investors who are listening. True or false? Can you only get 3 mortgages with the bank?
False. Not only 3 mortgages. You can apply for more than that. However, having said that, banks will at some point potentially stop the amount of mortgages that are with one particular bank or lender. It's not to say that you can't go get mortgages elsewhere. We have some other alternative options that we can reach out to if you do hit that cap, but you can get more than 3 mortgages with the.
Yeah, maybe next time we'll have a conversation about the financing opportunities for people who have more than 3 properties, because maybe mortgages are no longer the solution for you. But that is a whole other podcast, Kevin, and we are totally out of time. So
Yeah, we could go on for quite a while, couldn't we?
we sure could. One of my favorite subjects. A lot of people avoid financing and they avoid the math. But you know what? If you understand the money behind real estate, whether it's your primary residence or an investment property, you're going to be way better off. So thanks again, Kevin Reid. I really appreciate it. Kevin Reid from CIBC sharing all his financing insight with us. Thank you very much.
It was a pleasure, Scott. Thanks very much for having me.
Honestly, I feel like I just went through the mortgage pre-approval process there, because that's how it feels. I want to recap this for those of you who want to be a little more prepared when it comes to getting some financing. So the first thing we talked about is getting yourself organized, getting yourself pre-approved, and understanding the difference between the following 4 factors: the amortization, the term, the fixed versus variable rate, and the open versus closed mortgage. Those things have a massive impact on your decision-making process. So you got to consider how long you're going to have the house, what type of property it is. Do you need cash flow? Blah, 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 blah. Very important. All right. Second thing is to get the right mortgage for your situation. Always speak to a mortgage advisor. Okay. This just makes sense. This is common sense. Let them work with you through the process. And of course, make sure that you look at all of your options. Maybe there's a way to do a bridge loan if you need it. Maybe there's equity in your primary residence. But there's lots of different ways to finance real estate. Learn what your options are. This is the best way to do it. Now, at the beginning of the podcast, I did mention that I bought my first house, even though I didn't have a lot of money, because it was my first home, my primary residence that I lived in, and a rental property. I could qualify for an insured mortgage at 95% loan to value. So conventionally, with a mortgage, I got 95% of the financing that I needed. But where did I get the other 5%? I used my student loan. I know this is not probably a great piece of advice, but I always like to be honest with people. When I was graduating university or close to, I realized that I was spending most of my student loan on rent. So I used the last installment of my student loan as a down payment on a property, which ended up being less than 15 months worth of rent. So it was the right decision. I let the math do the talking. I'm sure we'll go over this all more detail on a future podcast. But for now, that is how I bought my first property. And I advise you to start looking into your financing options if you're thinking about real estate. Thanks so much for tuning in. If you want to learn more about home buying and financing, you can visit CIBC.com. They've got a ton of helpful resources. You can also visit the Real Estate Rebel Facebook group. Make sure you are following my Facebook page and then click on the group. I pop in pretty often to see what you guys are up to and answer your questions. Make sure you guys follow and like our podcast wherever you listen to it. You can check out all the links at scottmcgillivray.com. Thank you so much for listening, and we'll talk to you soon.